All right, everyone, brace yourselves. We've just witnessed a stunning twist in the US-China trade war. We said it was coming, that Besson would fold, but no one predicted how fast. The so-called pause arrived not with strategy, but with desperation. It came early, unexpectedly, and with a clear message. The US is skidding toward crisis, and Trump is scrambling to pull the emergency brake. The speed of this reversal doesn't suggest confidence, it screams panic. And when you look closely, you realize this wasn't a negotiation, it was a retreat. China walked into these talks holding the high ground. Sure, exports to the US dropped over 20%, but that didn't dent them, because their overall export earnings still rose by 8%. Why? Because the rest of the world kept buying. Global demand for Chinese goods remained solid, while America's threats landed with a thud. Even more importantly, China's dependence on US exports has been crumbling since 2008, shrinking from 1.8% of GDP to under 0.8%. That's not just a statistic, it's a strategic transformation. China no longer needs the US consumer the way it once did. Its middle class has stepped in, and the world's markets have stepped up. Meanwhile, the US economy still leans heavily on cheap Chinese imports to suppress inflation and keep production costs down. So if this were a poker game, China didn't just have a strong hand, they were sitting on a royal flush. And Besson's bluffs? They fell flat. We watched Trump fluctuate between 145% tariffs and 80%. Then Lutnick came in claiming the final rate would be 34%. It was chaos, no consistency, no leverage. Trump wasn't negotiating with China, he was negotiating with himself. And in the end, the game collapsed. But here's the real dagger, the decisive factor, inflation. China's inflation is near zero. The US? Sitting at 2.4% and climbing. That means Beijing can unleash fiscal and monetary stimulus without fear. They can go full throttle, launch spending programs, cut rates, inject capital, and still keep their currency stable. Washington? Not so lucky. If Besson dared to flood the market with bonds or force the Fed to slam interest rates down, the dollar would nosedive. The US economy would reel. The world's faith in American stability would crack. So it's no wonder the US folded. Behind closed doors, the discussion was likely blunt and one-sided. The Americans were cornered. China didn't need this deal. They could take it or leave it. And that's exactly how they played it. Now we have a pause. Not a breakthrough, not a resolution. Just a delay, a 90-day ceasefire. Tariffs on Chinese goods drop from 145% to 30%. China's tariffs on US imports ease from 5% to 10%. A temporary gesture. A breath between rounds. But make no mistake, this isn't a Trump victory. It's a tactical retreat dressed up in fireworks and spin. If you're looking at this from an investor's perspective, you need to cut through the theatrics. Who really gained here? Let's rewind to the start. Trump imposed a 10% tariff back in February. China responded with nothing. Fast forward through months of escalation, and what do we have? US tariffs now rest at 30%. Chinese tariffs sit at 10%. So who blinked first? Who paid the price? And here's the part that too many still don't understand. It's not Chinese exporters who shoulder the cost. It's American consumers. It's US businesses. The import burden is triple that of what China is paying. That means higher costs for US manufacturers, higher prices for everyday Americans, and a direct hit to economic stability. Even at 30%, it's a net negative, a drag on the system. And the nature of what each side exports? That's critical. China sends high-tech goods, electronics, semiconductors, smartphones, strategic products that Washington couldn't afford to hit, which is why the US handed out tech exemptions like candy. Meanwhile, the US exports raw commodities, soybeans, corn, oil, LNG, all of which can be easily replaced. China can dial up Brazil, Saudi Arabia, Russia. Problem solved. And they're increasingly settling these trades outside the US dollar. That's a shift with profound implications. So no, China didn't lose sleep over these tariffs. Their economy didn't buckle. They adapted. Quietly. Efficiently. And Besson? He gets to parade this pause as a win. He gets his headlines, his applause, his 15 minutes. But it's just theater. Because while he's selling victory to the American public, the data tells another story. In April, China's export earnings increased. The war barely grazed them. And then there's this. It wasn't China chasing Washington for talks. It was the US delegation scrambling to arrange a sit-down in Switzerland. That's the tell. That's the real power dynamic. And what sealed it? China agreed to suspend non-tariff countermeasures. Specifically, restrictions on rare earth exports. Their nuclear option. They didn't even need to use it. They just kept it on the table, and that alone was enough to bring the US to heel. So here we are, a fragile truce, a lull in the storm. But nothing has been resolved. The power balance has tilted. And as we move into the next phase of this economic conflict, one thing is crystal clear. This isn't just about tariffs. This is a cold economic war, and round one ended with the US on its knees. Beijing made a move that sent shockwaves through global markets. It halted exports of 7 critical minerals to the United States. These aren't ordinary materials. They're vital to semiconductors, electric vehicles, aerospace systems, and even military hardware. By cutting off the supply, China was effectively saying, "We can raise the cost of your future." It was a precision strike, targeting the core of American industry and innovation. Input costs surged. Supply chains faltered. The message was clear. China still controls the choke points of the global economy, and they are willing to use that control as leverage. But now, almost just as quietly as the restrictions were imposed, Beijing is reversing course. The minerals are flowing again. No press conference, no joint announcement, just a subtle change in posture. That silence isn't empty, it speaks volumes. Something changed behind closed doors. The world wasn't shown the deal, but make no mistake, a deal was made. The most likely scenario is this. Washington has agreed not to interfere in China's management of its currency. The US has effectively stepped back, giving the People's Bank of China full autonomy to manipulate the yuan as it sees fit. That means Beijing can devalue the currency to supercharge exports when needed, or strengthen it to boost domestic purchasing power. It's a massive win. In the long game of global trade, currency control is a weapon, and now China is free to use it. Markets responded immediately. US stocks shot up as expected, but what caught many by surprise was the rally in Chinese equities. A 3% gain in one day. That's not a reaction to a minor headline. That's confirmation. It's the markets signaling that China just walked away with an edge. Look deeper. Year to date, both the Hong Kong and Shanghai markets are up more than 16%. That's a surge, and it's not based on hope. It's based on power, on leverage, on the belief that Beijing is not just surviving these negotiations, it's thriving. And it gets more interesting. The original 145% tariffs on Chinese goods, crippling, unsustainable, and economically dangerous, have been rolled back to 30%. Still painful but manageable. That means American importers are once again willing to do business with Chinese manufacturers. US companies, Apple among them, can keep producing in China without taking a full financial hit. In other words, decoupling has been paused, maybe even reversed. The White House can spin it however they want. Trump can declare victory on a podium and wave to the cameras. But beneath the surface, the US gave more than it got. This wasn't a draw, it was a quiet retreat. If we're grading this, China earns an A-. The US, C, maybe C+ on a generous curve. But here's where it gets unsettling. While equities are climbing, the bond market is sending a very different message. US Treasury yields are rising sharply across the board. The 2-year yield is brushing up against 4%. The 30-year is closing in on 4.9%. And the 10-year, the bellwether of long-term economic confidence, is threatening to break above 4.5%. Why does that matter? Because rising yields mean falling bond prices. Investors are selling off US government debt. And they're not doing that because they're optimistic. They're doing it because they smell risk. Serious risk. When people dump US bonds, it usually comes down to one of two things. Either they believe the dollar is going to lose value fast, or they believe inflation is going to be higher, for longer. Neither of those outcomes is good, and both may be true. Yes, a 30% tariff is more sustainable than 145%, but it still raises prices. Across the board. It still locks in inflation and keeps it circulating through every layer of the economy, from production to logistics to the end consumer. Meanwhile, supply chains are in tatters. Imports from China had collapsed during the high tariff standoff. Turning that spigot back on won't be instant. It will take time to repair relationships, restore logistics, rebuild flow. And when imports do return, they come with a 30% tax attached. Companies will face margin pressure. They'll struggle to absorb costs without raising prices. Profitability will drop. Some businesses might stagnate. Others might cut jobs. When that happens, pressure builds on Washington to step in and subsidize, just to keep key sectors afloat. At the same time, the Trump administration has promised tax breaks to global firms considering reshoring operations. But that adds more fuel to the deficit fire. Increased spending, shrinking revenue, more borrowing, more bonds. And that's the key. The fear that's gripping the bond market is not just about inflation. It's about debt. The supply of US debt is about to explode, and global investors are bracing for it. They're saying, loud and clear, "We don't want to hold US paper, not in this climate." Instead, they're fleeing to cash. Not gold, not real estate. Cold hard dollars. Which, ironically, strengthens the dollar in the short term, even as long-term confidence erodes. This divergence is one of the most ominous signs in the market. Stock prices are going up, but bond investors are bracing for something worse. That disconnect doesn't last forever. One side is going to be proven right, and when it breaks, it will break hard. On top of all this, there's no clarity in U.S. trade policy. One day it's maximum tariffs, the next it's back to business. That kind of unpredictability makes it impossible for companies to plan long-term. For a firm thinking of reshoring a factory to the U.S., there's only one question that matters now. Is this tariff pause permanent, or just another bluff? Because if the pause holds, what's the incentive to relocate? Why invest in expensive U.S. operations when China is once again open for business and costs less? Without a clear strategy from Washington, global manufacturers are in limbo. And the longer that limbo lasts, the more likely they are to stay where they are, or worse, double down on offshore operations. So let's be honest. This was not a deal made from strength. It was a deal made from pressure. China applied it. The U.S. responded. And now, as the dust settles, the world is watching to see who really gained the upper hand. Was it Beijing with a masterclass in economic pressure and diplomatic subtlety? Or was it Washington, with a short-term relief that may have cost them long-term control? Let me know what you think. Who truly walked away with the better deal?